Every order you place lives or dies at a level. Support, resistance, and trend lines are not lines on a chart, they are memory. They mark where buyers and sellers last fought and where they are likely to fight again. Today, we go beyond drawing pretty lines. We will cover the order flow logic, how to rank levels by strength, exact entry and exit triggers, and the traps that punish even experienced traders. Think of a price level like the floor of a crowded elevator. Support is the floor everyone is standing on. The more people leaning on it, the stronger it feels, until enough weight breaks it through. Then that broken floor becomes the new ceiling for anyone below trying to climb back up. That is polarity. Support becomes resistance, resistance becomes support. Every retest is the market checking whether the floor still holds the weight. A valid level needs 3 ingredients. 1. Multiple touches, ideally 3 or more with clean rejections. 2. Volume confirmation, you want heavy volume at the touch and lighter volume on the move away. 3. Time, a level that held for 6 months matters more than one that held for 6 hours. Quantify it. Count touches, measure the average reaction size in average true range units, and note the volume spike ratio versus the prior 20 bars. A trend line is just a dynamic support or resistance. The rules are strict. Connect at least 2 significant swing lows for an uptrend line, 3 to confirm. Use wicks, not closes, because wicks show where the auction actually reached. The angle matters. Lines steeper than 60 degrees rarely survive, while shallow lines between 30 and 45 degrees tend to hold longest. If you have to squint to make it fit, the trend line is not there. Stop drawing single pixel lines. Price reacts to zones, not exact numbers. Define a zone using the wick high and the candle body close of the rejection bar. That gives you an upper and lower boundary, typically 10 to 30 basis points wide on equities, wider on crypto. Your entry can be at the far edge, your stop just beyond the zone. This single change cuts false stopouts dramatically. You have 3 professional entries at support. First, the bounce entry. Wait for a bullish reversal candle inside the zone, enter on the close, stop below the zone low. Second, the breakout retest. Price breaks resistance, pulls back to it as new support, you enter on the rejection. Third, the failure test. Price wicks below support, reclaims it within the same or next bar on rising volume, classic spring, or stop run. Here is a textbook setup. Price had ranged with resistance at 100. It breaks out on heavy volume to 103, then drifts back. The trigger is the retest of 100 holding as support, confirmed by a bullish engulfing candle on the next bar. Entry on the close of that candle. Stop goes below the engulfing low, not at 100 flat, because everyone places stops there. Target the next prior resistance using a minimum 2-to-1 reward to risk. If price closes back inside the old range, the setup has failed and you are out. Look at Apple on the daily. Notice how prior swing highs become support on the pullback and how the rising trend line catches multiple lows. Each touch is a decision point. Watch the volume on the rejections versus the breakouts. That is where the conviction shows. Where the trend line and a horizontal level intersect, you get confluence, and those are the highest probability reaction zones. A single level is a guess. Confluence is an edge. Stack your reasons. A horizontal level, a rising trend line, a Fibonacci retracement at the 61.8, a moving average like the 50 or 200, and a volume profile high-volume node. When 3 or more of these line up within one average true range, your probability of a clean reaction climbs sharply. Trade the confluence, not the line. Levels lag because they require touches to form, and the cleanest levels are obvious to everyone, which makes them targets for stop runs. Trend lines are subjective. 2 traders draw 3 different lines on the same chart. In low volatility regimes, false breakouts dominate. The fix: demand a closing break, not just a wick, and require above-average volume on the breakout bar. No volume, no validity. 3 traps catch experienced traders. 1. Curve-fitting trend lines until they touch every wick, which means the line has no predictive value. 2. Ignoring higher time frames, a daily level beats an hourly level every time, always draw top-down. 3. Treating round numbers as automatic levels without confirmation. They often work, but only when price has actually reacted there before. Respect what the chart shows, not what you wish. Tomorrow, open your top 3 tickers on the weekly first, then daily, then your trading time frame. Mark only the levels with 3 or more touches and a clear volume response. Draw trend lines using wicks, demand 3 points. Wait for either a bounce with a reversal candle or a breakout with a close and volume, then retest. Stop beyond the zone, target the next structure, minimum 2 to 1. This is education, not financial advice. Trade your plan, manage your risk, and let the levels do the work. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.